While financial markets can be risky, options are much riskier and require expert knowledge to trade and master. Let's start by quickly going over the most basic explanation of what options are, even though they trade like a standard instrument. But before that, if you think you will gain value from this video, consider liking and subscribing. In this video, we lay out an easy guide to understand the basics of options trading for a beginner. An option is essentially a contract that allows two investors to speculate on the value of an asset without actually owning the asset. Let's break this down with an example. Assume a trader has opinions about the price of Tesla's stock. After 3 months, we can refer to this trader as a Tesla bull. When Tesla bull discovers another trader who has the opposite opinion of him regarding the company's stock price, we can refer to him as the Tesla bear. He decides to speculate based on his belief that the market is mispricing the stock and that the actual value of the company is higher and that this should be reflected in the stock price in 3 months. Tesla bull and Tesla bear enter into an agreement that lists their views, thereby providing Tesla bull the right to buy the shares from Tesla bear at a predetermined price. This is called the exercise price. So for example, if the price agrees between both parties is $165, Mr. Bull has an option to buy the stock at $165 after 3 months. Now if the stock price at the end of 3 months is $190, the bullish trader stands to gain $25 from the agreement, as he can now buy the shares at a lower price from the bearish trader. The bullish trader exercises the option and can sell the shares immediately at $190, carving out a nice profit. On the other hand, if the stock price after 3 months is lower than the agreed $165, the bullish trader can choose not to buy shares at $165 because those shares are available at a better price. But is this a bad deal for the bearish trader? He loses when the price goes up and doesn't gain when the price moves down. Well, not really. Enter options premium, which is an element in the agreement that will safeguard the interest of the Tesla bear. There would be a premium amount agreed upon at the time of the contract, and it will be paid by the Tesla bull to the Tesla bear for bearing the risk. The premium is non-adjustable and non-returnable, which means the bear keeps it irrespective of the outcome. So if the premium amount is $10, the Tesla bull gains only $15 from the contract. If the price closes at $190 after 3 months, Tesla bear's loss is also $15, as the $25 loss at the time of exercising the contract gets covered by the $10 premium he received while entering the contract. On the other hand, if price closes below $165, the Tesla bull loses the $10 premium and the Tesla bear gains the same amount as he gets to keep the premium. In this example, the Tesla bull will be termed as an option buyer and the Tesla bear will be termed as an option seller. An option buyer has the right but not an obligation to honor the contract, and an option seller has an obligation to comply if the option buyer chooses to exercise his right. In the example, because the option buyer was bullish on the Tesla stock, the option he will use is a call option. A put option gives the option buyer the right to sell the security at a predetermined price. So for example, if the exercise price is $165 and the stock closes at $140 after 3 months, the put option buyer can still sell the stock at $165 to the option seller and pocket the cash. If the stock closes above $165, the option seller gets to keep the premium. But how is a premium calculated? If the buyer is bearish, he can use the other category of options called put options to speculate. 3 primary factors contribute to the premium of an option. 1 is the option's inherent value, also known as its moneyness, which indicates how much it is worth. 2 is the option's time value. The option's time value increases with the distance from its expiration date. 3. The option's implied volatility. The more volatile the option, the higher the premium. Beyond the fundamentals of options, an option seller has an unlimited downside and an upside limited to the premium received. An option buyer, on the other hand, has an unlimited upside and a defined downside because the maximum loss is the premium paid. Since there are many intricacies added to this arrangement in the financial world, it is best for beginners to grasp options in their most basic form and gradually expand their understanding in a decentralized, non-digitized financial system. For investors, entering into such contracts could be a nightmare. The next step in learning how to trade options profitably is to locate the counterparty, decide on the terms of the contract, and assume the risk of the counterparty defaulting. However, thanks to technology, all of this can be done with the click of a button on the majority of brokerages. All you have to do is choose the asset you want to speculate on, choose the exercise price or strike price, and pay or receive the premium quoted on the exchange. This mechanism may be based on qualitative elements such as sentiments or on quantitative elements such as charts and data. For instance, if your trading philosophy is breakout trading, you will be alerted when the stock you are eyeing to trade is breaking out on the chart. Once the breakout occurs, you can purchase call options and wait for the breakout to succeed or fail. The key takeaway from this is that you must keep an eye on the price of the underlying stock and trade the options only when specific trading conditions are met. The complexity and risk of trading options are much higher. You can increase your capital, but you also run the risk of losing all of the premium you paid. It's important to keep in mind that premiums can fluctuate significantly throughout the day based on the price of the underlying security. For example, if the premium you paid at the time you bought the contract was $10 and the underlying security was priced at $100, the premium could be quoted at $25. If the price moves by 20% to $100, that's a 15% return on the premium paid versus a 20% return on the underlying asset. On the other hand, if the underlying price drops by 20%, the premium. This is how leverage works. In summary, a minor fluctuation in the underlying price can result in a significant variation in the option premium. This movement is mostly determined by three previously discussed factors. Leverage, or magnifying, can enable options traders to make money with a small amount of equity if they have a positive expectancy system in place. For this reason, having a system is the most crucial component of trading options. You cannot buy and sell options at random and expect to make money. Instead, in order to trade options successfully, you must choose an underlying asset that you can monitor regularly and comprehend its fluctuations. Examples of such underlying assets are stocks and index funds. Currencies or commodities. As you continue to trade options, you will discover many more subtle aspects of the market. Lastly, given the magnifying effect of potential losses, risk management is the most crucial component of options trading. The finest choices. Traders avoid taking on more than 2% of their capital in a single trade because trades can end in a loss and large exposures can be disastrous for your trading account. These kinds of losses are swift and severe and can occur more frequently than you might think. Remember that it's best to start small when trading options and develop a skill set that enables you to consistently generate profits. Only after a lot of practice can you hope to have a decent trading system that consistently executes trades and is more right than wrong. Thanks for watching, trader.